It was the day the market stopped breathing. October 29th, 1929, the day known forever as Black Tuesday. The ticker tapes ran hours behind. Fortune after fortune vanished in minutes. And as the dust settled, one question echoed across America. How could it all collapse so fast? Nearly a century later, that question has returned. With markets soaring, debts piling high, and uncertainty rippling through the global economy, many wonder, are we standing on the edge of another 1929? Welcome to Financial History Uncovered, where we explore the money stories that shaped our world and ask what they mean for our future. Today, we're diving deep into whether the modern financial system could ever experience a crash as devastating as the Great Depression, or if the world has learned how to stop history from repeating itself. To understand whether history could repeat, we first need to return to where it began. The Roaring Twenties, an age of wild optimism. America had just won a war. New technology was transforming daily life. Cars, radios, airplanes, the motion picture industry. Productivity was booming, and so was confidence. Everyone wanted a piece of the future. And the future, they believed, was on Wall Street. By 1928, stocks weren't just investments. They were lottery tickets to the American dream. Ordinary families poured savings into the market. Investors borrowed money to buy more shares, a strategy known as buying on margin. With just 10% down, they could control massive positions. As long as prices rose, fortunes multiplied. But beneath the glamour, cracks were forming. Corporate earnings weren't keeping pace with stock prices. Debt levels were exploding. And the Federal Reserve, worried about speculation, raised interest rates, tightening liquidity just as the bubble had reached its most fragile point. Then came October 1929. It started as a whisper, a few traders selling here, a few banks calling in loans there. Then panic took hold. Investors raced to liquidate. Prices plunged. In a single day, the Dow Jones Industrial Average fell nearly 12%. Within weeks, the market had lost nearly 90% of its value. Millions lost their jobs, thousands of banks collapsed. The prosperity of the 1920s was erased almost overnight. The crash didn't just end a decade of growth. It reshaped the entire financial world. Fast forward to today, the names are different. Tesla, Apple, Nvidia. But the energy feels familiar. A world awash in liquidity. A generation convinced that markets only go up. We live in an era of near-zero interest rates for most of the past decade, followed by a sharp tightening cycle from the Federal Reserve to curb inflation. Cheap money has fueled sky-high valuations in tech and growth sectors. Some analysts say we've been living through a modern Roaring Twenties, driven not by railroads and radio, but by AI, crypto, and algorithms. Retail investing is at record highs. Millions trade from their phones, moving billions with a swipe. Margin debt, money borrowed to buy stocks, has again reached historic levels. And global debt, both public and private, has surpassed 300 trillion. Sound familiar? There's a rising chorus asking, is this 1929 all over again? The exuberance, the leverage, the belief that this time is different. Even the Fed's role draws comparisons. In the late 1920s, policymakers underestimated how their tightening would choke the economy. Today, central banks face a similar dilemma: cool inflation without triggering a recession. Yet, despite these parallels, the world of finance has changed beyond recognition. And that's where our story takes a turn. If the 1920s were a free-for-all, today's markets are built on layers of protection designed to prevent collapse. First, the Securities and Exchange Commission. Born from the ashes of 1929, the SEC enforces transparency, regulates trading, and polices fraud. Back then, companies weren't required to disclose financials. Today, quarterly reports, audits, and filings keep investors informed, or at least better informed than before. Then there's the Federal Deposit Insurance Corporation, or FDIC. In 1929, when banks failed, depositors lost everything. Now, even if a bank collapses, insured deposits are protected up to hundreds of thousands of dollars. This single reform has stopped countless bank runs before they could begin. And let's not forget the Federal Reserve itself. The Fed of 1929 was young and uncertain. The Fed of today is armed with powerful tools, from quantitative easing to emergency lending facilities, to stabilize financial shocks. It doesn't always act perfectly, but it acts quickly. Modern markets also have built-in circuit breakers. If trading plunges too fast, exchanges automatically pause. Those few minutes of breathing room can stop panic from spiraling out of control, something that didn't exist when ticker tapes fluttered through the streets of Manhattan. And then there's diversification. In 1929, the average investor was all in on U.S. stocks or local banks. Today, portfolios are spread across global markets, sectors, bonds, and alternative assets. Institutional investors, pension funds, ETFs, sovereign wealth funds add stability and liquidity that early markets lacked. Of course, none of these safeguards make the system invincible, but they change the game entirely. The world doesn't eliminate risk, it manages it differently. Still, the question lingers. If not a 1929-style crash, could something else bring the system down? Today's vulnerabilities look different. Instead of margin clerks and ticker tapes, we have algorithms and high-frequency trading. In seconds, automated sell orders can trigger massive volatility, a flash crash at the speed of light. Debt is another shadow. In 1929, corporate debt was the problem. Today, it's government debt, soaring to levels unseen in peacetime. If interest rates stay high, servicing that debt could strain budgets and slow growth for years. Then there's the psychology of the modern investor. In 1929, panic spread by newspaper. Now, fear spreads on social media. Instant, viral, unstoppable. One tweet, one rumor, one viral video can move markets globally. And let's not ignore asset bubbles outside the stock market. Housing, crypto, even collectibles. When money is cheap, it flows into everything, until it doesn't. So yes, the stage is different, but the actors are the same. Greed, leverage, optimism, and fear. History doesn't repeat itself word for word. It rhymes. In rhyme schemes written by human emotion. What the 1929 crash teaches us isn't just about markets. It's about human behavior. Back then, the belief that stocks can't go down blinded investors to risk. Sound familiar? It's easy to mock those who lived through the Great Depression as naive. But the truth is, they were doing what most investors still do. Chasing opportunity, trusting that tomorrow will be better than today. And that's what makes bubbles so powerful. They're built not just on money, but on hope. In 1929, the crash destroyed that hope for a generation. Today, our institutions work tirelessly to prevent that same despair. But even the best safeguards can't stop human nature. The next crash, whenever it comes, won't be a carbon copy of 1929, but it will echo it in spirit. So, will a repeat of 1929 happen today? The honest answer, probably not in the same way. Our financial system is far more complex, regulated, and resilient. But complexity cuts both ways. It hides risks we may not yet see. Maybe it won't be stocks that break first. Maybe it'll be a currency crisis, a debt spiral, a geopolitical shock, or a sudden loss of confidence in the digital systems we take for granted. Crashes rarely come from where we expect them. Neither did 1929. That's why studying financial history isn't about predicting the next disaster. It's about recognizing the patterns that lead us there. Speculation, overconfidence, leverage, and inequality. The ingredients are timeless. Only the tools change. The Great Depression reshaped how we think about money, risk, and responsibility. It gave birth to modern financial regulation and central banking. And every crisis since, from 1987 to 2008 to 2020, has tested those lessons again. But here's the truth. Every generation forgets. Every generation thinks it's smarter, faster, safer, until it isn't. So no, the next crash may not look like 1929, but the emotions, the euphoria, the panic, the disbelief will feel exactly the same. Because markets are mirrors. They reflect not just our wealth, but our psychology. And the one constant through every century of finance is us. If you found this deep dive helpful, hit like, share it with someone who loves financial history, and tell us what you think. Are we safer than ever? Or just dancing to a new tune on the same old floor? And if you want to understand how crises evolve, watch our next video. How the 2008 meltdown rewrote the rules of modern capitalism. Because to see the future of money, we first have to uncover its past.